Team Canada hat. Still reveling in the big hockey win.
Oh, I don't know about that. I think it's more of doesn't stand for Craig or Clark or anything like that. I think it's I'm talking.
I thought it was a Chicago Cubs hat, actually, but
No, this is an all Canada hat. Here we are on March 4th, the day 25% tariffs get implemented in Canada here, and I'm all about supporting our own country here. So I wish I had "Make Canada Great Again." I don't at home, but I've got a Canada hat here to support our country.
yeah, it's really been an interesting week when you look at these tariffs coming into effect today. We'll see how long those last. But some of the geopolitical stuff for last week out of the White House, berating Zelensky in the White House late last week, now cutting all military support, the vote in the United Nations with Russia by the United States, just remarkable week that obviously there are going to be some repercussions coming out of this.
Whoever thought it would be easy, hey? With Trump and his administration. We said that coming into 2025, and here we are. Jay, you probably got some good stuff on the docket today. I'm sure our clients and listeners are wondering where we're at. So why don't we get into it?
Yeah, lots to chat about. Welcome to episode 20 of Wealth Talk, unraveling current events and market trends with Plena Wealth Advisors. We've got, as always, Craig White up in our Kelowna office, Clark Linton, and myself, Jay Snyder, here in Vancouver. And like we said, much to discuss today, March 4th, Tariff Day. But before we get into that main event, maybe, Craig, do you mind walking us through where we're at year to date with the markets? A couple months into 2025 and Trump's second term, lots going on. So what are the markets telling us?
Again, I think that's probably top of mind for a lot of our clients these days, in particular the last couple of weeks. Again, if you kind of look at how we prefaced coming into 2025, it was all about expecting more volatility. And outside of the past couple of weeks, I'm going to say markets were performing pretty well. And that's a reflection of, I think, fourth quarter earnings out of the U.S. in particular that came in above expectations. On the revenue side, it was a little bit softer, but bottom line earnings were pretty constructive. I think over the last couple of weeks, we've seen a little bit of a mixed economic data as well. Inflationary pressures have seemed to pick up a little bit in the face of weakening GDP as well. So you kind of got a mixed bag over the last couple of weeks, and what that resulted in is some volatility within equity markets since they peaked. The second, third week, I think we saw a peak. And that being said, year to date, I think even coming into today, Toronto's flat, maybe down 1%. The Dow Jones is flat. The Nasdaq's seen a little bit more pressure, down kind of 5-6% year to date. But all things considered, and I'm going to say markets are reflecting some of this recent geopolitical and tariff talk.
So Craig, we talk a lot about that. Our clients, the media headlines, and I mean, even us, we tend to talk about markets. Whereas really markets and the portfolios we manage are a basket of stocks. We invest in companies. And just curious on your thoughts, if you can maybe dive into the market a little bit here and explain maybe some of the differences we're seeing in certain sectors or certain companies in the market year to date.
Well, if you really want to get into details, let's take the Dow Jones. And I'm just going to kind of try to explain it here. You'll often hear the media come out and say stock markets plunged. The Dow was down 600 points or what have you. And if you look at how the Dow is constructed, it's made up of 30 different publicly listed companies, and generally the large cap companies in the U.S. The largest or the highest priced stock, I believe, on the Dow is Goldman Sachs, and I think it's around $600 per share. If Goldman Sachs moves up 10% or down 10%, that can reflect anywhere from 350 to 400 points on the Dow. So one highly priced stock can impact the direction of the Dow. Take that in the context of a Dow company like Nike that is priced around $80 per share. If it moves up or down 10%, that may be reflected with a 40, 50, 60 point move in the Dow. So the higher priced stocks have a more impact on their overall direction. So when people say, what are the markets doing? I think the better thing is, what are the individual components of the markets doing? Because each name has a different representation. That's the real fine details. What's happening within markets, to your point, Clark, sector-wise, if you look at what's performed well over the last, couple, 3-4 weeks or last month, healthcare has been a strong leader. You've seen utilities, real estate start to pick up. Not surprisingly, financials. If you look at Canadian financials, they reported, I think, the third week of February here. And for the most part, they were a pretty solid beat across the board. A lot of those Canadian financials are within a few percent of an all-time high here in Canada. So
yeah, to that utilities, REIT, some of the interest rate sensitive sectors, with interest rates coming down over the last few weeks, some of these sectors that were laggards over the last year or so are starting to pick up. On the flip side, what's really worked well over the last couple of years, and we've had really good exposure in portfolios to these, the mega cap technology companies like Amazon, Microsoft, Google, starting to see some weakness. And, that may end up being a healthy rotation. And, in portfolios, a few weeks ago, we did trim a lot of our technology holdings. We still love the companies. We're still going to hold them over the long run, but recognizing valuations, looking at maybe some of these changes in the market from a sector rotation perspective, I think that's part of what we're seeing here as well.
I think the other thing worth pointing out is so far year to date, and since Trump's inauguration, is the bond markets are actually finally leading the equity markets in performance, which is a little bit of an interesting change of leadership. And I mean, I think a lot of this is really who knows how these tariffs and what the impacts are going to end up being, but a lot of this is just kind of a cooling off phase at this point after 2 really, really strong years in the market. I mean, it wasn't going to go straight up forever, and now we're seeing either some rotations, some adjustments to valuations, and as portfolio managers, I think we've been pretty good at getting ahead of this to some degree, taking some profits and in places where we saw expensive valuations and reallocating to some of the cheaper areas of the markets. You mentioned, Craig, or Clark, the real estate sectors, the utilities, the telcos, some of these kind of beaten down areas of the market that we've been happily picking up at pretty discounted valuations.
And here's the thing: when again the news and the media, talk about stock markets plunging and what have you. Again, it's all about how that's positioned and referenced. There's an interesting chart that I actually came across this morning, and it talked about the S&P 500, that since 2009, so that was the low of the financial crisis, this is now the 31st pullback of 5% over that time frame. So for the media, for any investor to think that this is abnormal or this isn't part of a market cycle, well, again, we faced this 30 times over the past, 15 years now. So, and you can point to a number of different things, whether it's tariffs or inflation or Greece or recessionary fears. There's always going to be a reason for this to happen, as opposed to embracing it and trying to time the market. We as portfolio managers, the better way to look at it is say, where do we want to position our client portfolios, and where is there opportunity to put cash to work if we have that within accounts? And that's how we're viewing it right now. As I often say, volatility should be seen as opportunity, not an enemy. And that's how we're looking at things right now.
A good point. I think it's no one likes to go through these periods of corrections, but for those with a little bit of cash available, it's and a long-term time horizon, it's definitely something we look forward to some degree.
Jay, one thing you mentioned there is the bond market. What do you talk a little bit about, kind of what you're seeing there, or why do you think bonds have held up a little bit better here relative to, let's say, 2022 when all asset classes were falling?
Yeah, so I mean, bonds are always going to be driven primarily by interest rates and the direction of those interest rates, and we've seen interest rates continue to come down over the last kind of 6 months as inflation has continued to moderate. What's kind of happening now is a bit of a tug of war between inflation and the impacts of these tariffs, which largely should be inflationary to pricing across kind of consumer goods for sure. But now there's an increasing demand for bonds, as we see, and this is really kind of the historical norm, is when economic growth starts to come into question, investors look for options to put money into safer areas. And so demand for bonds tends to go up when economic storm clouds start to form. That's exactly what we're seeing now as investors are shifting out of equities, which, like I said, have had a pretty incredible run these last 2 years, much like we're doing, taking some profits on some stretched valuations and looking for better areas to deploy capital. And so that's moving a lot of money into the bond market. And so we're seeing, particularly these last few days, as volatility has really picked up, we're seeing bonds start to get a really nice bid. For those of us, and generally speaking, most of our clients are in some level of balanced portfolios where they've got a sleeve of allocation to bonds. That offset in volatility is actually extremely helpful. Like you said, unlike in 2022 when bonds and stocks both went down, not quite exactly in the same way, but in a similar direction anyways. Now we're seeing that historical relationship really start to hold, which is great as we're seeing equity markets drop slightly, bond markets are rising, and you're getting that really nice kind of volatility dampening effect take hold. So the big question now going forward is, do tariffs start to add to inflation, and does that start to bleed into the central bankers' decision making when it comes to what the next change in interest rate policy starts to look like?
I think you're right, Jay. I think there's a little bit more to that as well. And we talked about this a few podcasts ago when interest rates were actually moving up and all the headlines were saying, hey, that's because of, government overspending and it's going to be, more costly for them to raise money. And one of the things I said is just keep it simple. It's really the market at that point saying, hey, look, we thought we were going to head into recession. We're getting a soft landing here. Maybe things are not going to be as bad as expected. So interest rates started moving up. I'd say the opposite is actually happening now. And interest rates are now starting to telegraph, because of some of what's going on in the world, tariffs, some of the geopolitical things, that we may start to see a softening in the economy, and the bond market's pricing that in with declining interest rates. I think that's a large part of what's going on. Another thing that I've read recently, it's kind of an interesting perspective on it as well, is some of this, what is the Department of the States that Elon Musk is running, DOGE, whatever that acronym means, but cutting government expenditures, is that the U.S. government has I think it's some crazy number, like $6 trillion in debt coming due over the next year or so. And obviously there's an incentive to roll that over at lower interest rates. Also, just with this notion now that they're making so many cuts that possibly this does cut into the deficit, potentially that's causing some decline in interest rates as well.
I think Bank of Canada, they're up in the next week or two with their next announcement, and I think market expectations are for 25 basis points now. Maybe we can transition, talk a little about tariffs. That's probably the elephant in the room that our clients do want to know what our thoughts are on that. But do you think the longer that these tariffs get drawn out, does that force the hands of the Bank of Canada to probably look at a 50 basis point cut in the near term here?
I doubt it. I think there's going to be a wait and see approach here. I think, another thing that I've heard recently is that even those in the administration with Trump, they kind of have the 72-hour rule, which is when he announces something or enacts something or whatever it might be, before you make any big decisions, wait 72 hours because there's a good chance that he's going to change things. And I think the Bank of Canada is going to take the same approach, is that by being too aggressive on cutting interest rates, they're actually making the assumption potentially that these tariffs are long lasting in nature. I'd be surprised if they are, but who knows? I also do think, central banks, continue to have inflation. It's somewhat top of mind, even though it's come down with a vengeance, but I still think that's an issue. I think they'll be a little bit more moderate than that.
Let's talk about tariffs. There's two scorecards that I think that Trump pays attention to. One is his golf scorecard, which he probably was fudged a bit, and the second is going to be the economic and stock market scorecard. So, Jay, where are thoughts at with respect to, the impact of tariffs, what we can look at here in Canada? Where are we at?
I mean, without a doubt, these tariffs are not going to be good for the economy. And that's true both in Canada and the US. And if it creates more confusion and uncertainty around businesses that are operating on both sides of the border, that are doing any sort of exporting and importing, and that leads to less employment and less capital deployed in terms of investment in those businesses within themselves, that's just all going to be bad for the economy. I've seen reports suggesting anywhere from 2 to 4% in economic contraction from a GDP perspective. But at the end of the day, all of these are just guesses in terms of how long these tariffs are actually going to be in place for. And until we know that, and I truly don't think Trump has any idea what the plan is for how long these are going to be in place. I mean, he's out there claiming it's all for his agenda for America first and reshoring and all these sorts of things. If we have these tariffs in place for the rest of this year, I think the kind of economic impact of that is going to be quite significant. Again, both to Canada and the US. But I have to believe, like you said, because he has paid so much attention to the markets and because he's got obviously a ton of CEOs in his ear telling him what they think he needs to do to help their businesses, I have to believe that there's going to be something that changes his mind. I don't know what that's going to be. I think fentanyl and this whole kind of notion that Canada needs to get tough in terms of the drug trade is a little bit of a sideshow. But something that we'll be able to do that will encourage him to back off these tariffs is going to hopefully come to fruition sooner rather than later, before the economy really starts to feel the impact of it. But I'm curious. I don't know what that specifically would be. I think the Canadian-US relationship has been such a strong one for so long, and there's so much interdependence across the border. But I just you have to almost like give Trump this notion that he's won this trade war in some way, right? And give
You
him
could even say
something.
anybody wins though, right? No one wins in a trade war.
No, no one's winning, but Trump wants to win him. He only cares about his own record and what he can go back to his constituents and say. I think it's interesting, like the yesterday or the day before, Taiwan Semiconductor announced $100 billion investment in chip fabrication facilities in the US. So there's already kind of some instances of companies that are kind of reshoring, committing capital to the US, circumventing these tariffs in a way. And I think if you see more of that from some of these major cross-border entities, hopefully that kind of leads to cooler heads prevailing and sooner rather than later.
Now, if you look at how the markets have reacted over the last month or overnight, like yesterday when he announced these tariffs were going to go in today, and how markets are reacting today. Yes, markets are down 1.5 today. They were down 1.5 yesterday. So let's say markets in the last couple of days are down 3 to 4%. I think the Canadian dollar's dropped 2/3 of a cent in the last 24 hours. These are not huge changes. And they're not huge changes when you think about coming off of all-time highs in the market as well. So that's one thing I would point out. And I think maybe that's the market kind of telegraphing what we are saying, which is, these are probably not going to be long-term in nature. He is probably going to be using these to get a win somewhere. What is that win? What is he looking for? I can't get inside of his head. I'm not smart enough to figure him out. There's some interesting things, though. I don't know if you guys read that piece that's gone around. I think the writer was Stephen Mirren on kind of the playbook that he thinks Trump is doing on these tariffs. It's really the only real piece that's been sent. I'll send it to you guys. But there's a few things there. I think that if you read through that, you'll see that China and Mexico are not really who Trump thinks are the trade enemies per se. It's China. Yesterday, the Mexican president, although she's come out today with retaliatory tariffs, was floating the idea of actually mirroring the US's tariffs, but on China.
Yes.
Kind of a double play to give Trump what he wants. Hey, if your real attack here is on China, we're going to join you and we'll tariff China as well. And apparently that was getting a lot of traction within the administration. And I think that kind of points to maybe what he's trying to attack here is this is probably way more about the trade deficit with China than it is about Canada and the United States. The other interesting thing, and this is kind of the, other side of the coin as far as what he's thinking, is that, probably 150 years ago, I think it was in the 1880s, no income tax at all in the States. Basically all the government revenue, or the majority of the government revenue was from tariffs. Everything coming into the United States was tariffs. And then eventually tariffs came off to almost nothing and income tax replaced that. And, the other thing he might be looking at is, as he's looking to cut corporate taxation and personal taxation, does that offset the economic weakness that comes from tariffs enough that tariffs could become longer term in nature, because the economic offset is the positive that comes from lower corporate taxation and personal taxation, particularly, as you just mentioned, attracting foreign companies to the United States.
I think on that point, it's like if you look at the actual kind of comparative tariffs that the US applies relative to every other kind of developed country, Canada included, the US has by far the lowest tariffs. And I would argue that a large part of the economic prosperity that the US has enjoyed over the last 20, 50, 100 years is because they've really embraced that kind of open market philosophy. And you look at other markets that are much more closed, that have these kind of trade barriers, and they've been far less successful domestically and internationally. So it's I think just kind of poor policy to go the other direction and all of a sudden erect these trade barriers that are going to make them one of the most potentially closed economies in the world. And I think that's going to come to light pretty quickly here if these stay in place for longer than the next few months.
I think that's the key is attempting to try to time the end of these tariffs is impossible. Like you said, Clark, no one's smart enough to get inside the mind of Trump. But what I think that the longer that these tariffs exist, what this I think will do to talk with the other side of the coin is this is going to force Canada to look inside our own borders and how we become more competitive on a foreign standpoint. If you kind of look at, you're already starting to see provinces try to remove any sort of interprovincial barriers that they had within trade that have been in place for decades. I think this is, as opposed to viewing it as a negative, which yes, there's going to be some short-term pain, look at it from a longer-term perspective. This likely forces the hand of Canada to look at it and say, where can we continue to develop partners outside of the US? Whether that's building pipelines to get our LNG out to markets like China, whether that's forming better relationships with the Euro and the European Union. Again, it's short-term challenges, but again, I think there may be a silver lining at the end of the day here for Canada.
And keep in mind that Canada is not alone here, right? Is that when you look at Trump, my analogy is the schoolyard bully, right? He's not just picking on one kid. That's really easy for the bully, is to do that. He's picking on every kid in that schoolyard. And what ultimately happens is that bully finds himself very isolated eventually. And what you end up getting is you get, the schoolyard kids starting to form their own little alliances. And I think that's potentially, I think you're absolutely right, is if we look at one individual country like Canada, this is our opportunity to shine, to be honest, is that we have an opportunity here to exploit. We've got this kind of pro-Canada momentum, and hopefully this time around we're smart enough to see that, and we've got smart heads out there in Ottawa and Victoria, wherever it is, that actually start to make some smart decisions to take advantage of this. We do have the opportunity to come out of this stronger, I think, than we've entered this. I think Europe does as well. And in addition to that, I think new alliances form, whether they're trade alliances. Over the last week, I think it's quite evident maybe some new military alliances come out of this. This is pretty significant. And I think at the end of the day, I still think there's going to be some benefits out of the United States, but one of the big negatives is they can quickly find themselves extremely isolated, and that has some pretty significant negative ramifications for the US.
Yeah.
I mean, I think one of the things we've touched on a bunch of times in the last couple of years is the potential that Canada has, and how we really need to start unleashing that potential. And this is, you're right, an opportunity to double down on kind of what we're good at and how do we make our economy work for everyone. Kind of along those same lines with our leadership change happening this week. Mark Carney got himself in a little hot water as it was announced that his kind of last role as the director of the board of Brookfield Asset Management, he was instrumental in moving the headquarters from Toronto to New York, which is obviously not something we want to see ever happen. But it is a theme that has really been kind of more widespread across industry in Canada, with the likes of Encana, previously the biggest natural gas producer, moving headquarters to the US. You've had other kind of smaller examples of Nordstrom failing to survive here in Canada. You've got Lululemon changed their listing from Toronto to the US. Barrick, the biggest gold company in Canada and one of the biggest in the world, recently talking about relocating to the US. So why are we struggling to not only attract but just maintain the great businesses that we've developed here in Canada, and what can we do to kind of make sure that trend doesn't continue?
I think the first thing to look at, Jay, there is what is the motivation for somebody like Brookfield Asset Management, who, you are right, Carney was the chair of that company, as they made that decision. What is the motivation for them to move their headquarters to the United States? Now, you guys correct me if I'm wrong. I could have this wrong, but moving headquarters to the United States is far different than moving a corporation to the United States. And I believe that's what Brookfield Asset Management has done, and some other companies, is they move their headquarters to the US, but they remain incorporated in Canada. So they're still a Canadian tax entity, although obviously some of their operations begin to get taxed in the States. But Brookfield Asset Management, which out of most companies we know, it's one of our largest holdings, they thrive by raising capital from capital markets. We know how difficult that is in a country like Canada. And just by virtue of them relocating to the United States, in one of the main financial centers in the world, gives them way better access to capital to do exactly what their business is to do: raise capital and invest it. They have that way easier in the United States than they would in Canada. I think that's reason number one. I think reason number two, and we're not just seeing it with Canadian companies, we're seeing it with European companies, we're seeing it with Chinese companies, moving, as Lululemon did, moving their headquarters to the United States to get a US listing, with the hope that they get inclusion in some of the major indexes like the S&P 500. If they do, they attract a lot more investors that are more passive in nature, like ETFs, way better, or way more stable shareholder base. And I think that's a hope of a lot of these companies as well. So, does that really have to do with the economy in Canada or taxation in Canada? I think partly, I think maybe that's the ultimate outcome for companies like this. But I think there's other motivations rather than just, hey, Canada's faltering, Canada's tax system is negative, whatever it might be. So curious on your thoughts.
Yeah, I mean, I think that's the more palatable kind of explanation that companies will provide for moving to the US. I think Barrick was quite straightforwardly saying, Trump has been more has embraced the idea of resource extraction, and even they recognized an easier way to move to the US would just be to buy a US company and re-domicile there, and then you're going to benefit from lower regulations, better tax jurisdictions, all sorts of different things. When, particularly for a resource company, you're going to be treated a lot better. You also get the added benefit of deeper pools of capital and things like being included in the indexes, which is obviously helpful from a cost of capital perspective. I think for Canadian companies, though, and Lululemon's kind of an interesting example of this, where they actually threatened to leave Canada. They only ended up moving their listing to the US, but the reason they stayed is because they basically got an exemption to hire temporary foreign workers, which they were having a tough time attracting. And so they were basically allowed to go out and hire people under a special exemption. And I think this really speaks to the lack of kind of, or the challenge that Canada has in attracting people to our country that are skilled workers that want to work for great businesses. And a part of that is costs of living here. A part of that is the tax rates that you're paying here comparatively to the US or other places. So I think there's a lot of things kind of going back to the potential that Canada has. We really need to, and all of this trickles down to, I mean, it's one thing to talk about their stock listings and, you know, where they're domiciled and where their headquarters are at, but ultimately this all leads to employment. And ultimately this all leads to where the really high paying jobs, where the workforce is going to be located. And if we really want Canada to prosper, we have to continue to attract businesses to start here, to stay here, and employ people here.
What's the catalyst for that then? Is that, and we talked about in the past few podcasts, is that a change in Ottawa? Is that less taxation, less regulation, less red tape? And that doesn't happen overnight. So
well, I think it's all of those things, but I think, you know, it's a bad sign when the presumed prime minister to be is moving his own company to the US, which I don't know, maybe he's got good answers to solve that problem, but yeah, there's a lot of reasons behind it, obviously, and every company's a little bit different. But I think the last major company to move from the US to Canada, if you remember, in 2014, Burger King bought Tim Hortons as a tax play to move to at that point in time when we had very different leadership both in the US and Canada. Canada was actually seen as almost a better tax jurisdiction than the US. So Burger King actually re-domiciled to Canada, and that was more than 10 years ago, I think, was the last major Canadian company that did kind of the same thing.
Yeah, you're right. You're right, Jay. I think there's various reasons, but again, I don't think they're all tax driven. I think a lot of it is, you know, not to maximize it, but I think it is access to capital markets, access to a listing on a very widely invested US index. You know, company in China, I think the name of the company in China is Sexy Tea. They're one of those boba bubble tea places. That's what it's called. Apparently they have more locations globally, but in China, than Starbucks does globally or something like this. But obviously big access to capital. They have also relocated, or as far as a listing in the States, with a hope for a listing on a US index like that. So they've got no tax reason, no other reason, no less regulation in the United States to move to the United States. Their primary reason was to get a US listing, which may give them better access to capital.
very interesting. Yeah. Well, hey, let's circle back here in the interest of time. Key takeaways for our clients. As I listen to this podcast a couple days probably after we recorded here, Clark, what's your key takeaways right now with we as portfolio managers, what we're focusing on? What should clients really take away from our message right now?
I think we say this maybe too often, but I think we need to say it too often, is we do not invest in markets. We invest in companies. And we just gave some examples where, you know, we've got companies that are down 30 or 40%. You know, I can think of a few. You know, TELUS is a good example. A lot of that is driven by what interest rates have done over the last few years, and valuation of interest rate sensitive investments have come down. It's not the only reason why it's down, but a great company that will take advantage of, you know, record lows as far as valuation to invest in a company like that. And, you know, it's probably up year to date. I'm thinking it is up year to date while the markets are flat to negative. And I think that's really the message that I would continue to send, is that markets per se are a basket of companies or stocks that are going to do what they're going to do, driven, as you mentioned, Craig, in the Dow, because it's price weighted by the largest priced companies. The S&P 500, which is market cap weighted, the largest companies like Apple and Amazon and Tesla and Nvidia and all those are going to drive the performance of the market. What's going to drive the performance of our delivery of results for our clients are the companies that we invest in. And I just cannot hammer that home enough. And a TELUS or a Microsoft or a JP Morgan, regardless of how the geopolitical risks play out, regardless of how these tariffs play out, those companies are going to continue to get stronger in the decades to come. And that's what I'm most interested in for our clients.
Yeah,
I think that's a good place to leave it for the episode. And on top of that, as always, stay diversified and manage your risk appropriately according to your own personal situation is always what we're trying to do. So yeah, let's leave it with that, and go Canada, go, as we navigate these choppy waters here with Craig's hat on. And thank everyone for joining us. Please, as always, we welcome your feedback, and we'll see you next time.